Here's Bitcoin to gold. Gold is going down. Bitcoin had been going down. It seems to be in a bottoming process. We believe that it has bottomed on this basis and will resume the very volatile but broad uptrend that you see on this chart. Might be going on here is that companies are not hiring as rapidly as they once did, and they are relying more on AI, as many people are starting their own companies just with AI. It's a big recommendation from us for those of you who may be looking for a job. Just identify a problem you'd like to solve out there, one that frustrates you, probably frustrates other people, and start your own company. And do it with AI only.
Cathie Wood just connected two dots nobody else is talking about. AI is stealing jobs, and Bitcoin is about to make its move. Here's why these matters to you. Bitcoin just hit a turning point. Cathie Wood, CEO and CIO of ARK Invest, notes that both gold and Bitcoin have been sliding. But she believes Bitcoin has now formed a bottom relative to gold and expects the long-term uptrend to resume, though the climb higher will likely stay volatile. At the same time, the job market is sending a warning sign too, and it could affect you more than you think. Wood points to a clear culprit: artificial intelligence. Companies are slowing down their hiring. Instead of growing their workforce like before, businesses are leaning on AI to do more with fewer people. The impact hits hardest at the entry level, where AI now handles many of the routine tasks that once gave young professionals their first foothold in a career. If you're just starting, this is the shift you need to understand. The numbers back this up. Michigan's unemployment rate jumped to 5.1% in May, well above the national rate of 4.2%. Employers added only 57,000 jobs in June, far fewer than expected. Small business hiring plans have sunk to their lowest level since early COVID-19. Household employment dropped by roughly 500,000, while non-farm payrolls rose by just 57,000, half of what economists forecasted. Wood's answer is one you can act on. Stop waiting for a job offer. Find a real problem worth solving. Build an AI-powered solution. Launch a company using AI-first tools. The message is clear. AI isn't just reshaping jobs. It's reshaping what it means to be employable. Before you dive in, hit like and subscribe to our channel. Let's hit 1,000 subscribers together with your support.
Employment number was crazy. So household employment was down roughly 500,000. Non-farm payroll employment was up maybe 57,000, roughly half of what economists expected. So on that score, it was a very weak report. And you can see on this chart, rarely does this measure of employment decline in the absence of a recession, which you can see in the shaded areas. So what might be going on here is that companies are not hiring as rapidly as they once did, and they are relying more on AI. And the new business creations, which we are seeing from new business applications, that this measure of employment has not caught up with what's going on from an entrepreneurial point of view, as many people are starting their own companies just with AI. It's a big recommendation from us for those of you who may be looking for a job. Just identify a problem you'd like to solve out there, one that frustrates you, probably frustrates other people, and start your own company. And do it with AI only. And just see how much you can do and how much more eligible you will be for a job out there. You'll probably go to the top of the list. AI boom certainly is being sustained, and we believe that it's really just begun. We went through, 40 years where this measure of capital spending peaked kind of at the same place, and now we've just broken out and we're on our way. We do believe this is a revolution that's going to, as you know, change every company, every industry, every sector as these technologies converge, AI converging with all of the other technologies out there. We think there could be a breakdown in the Treasury yield if we're right that inflation will move well away from the 4.2% headline that is the CPI right now, to something much lower. Trueflation's already lower, and we could see that going negative. The government measures may be moving into the 1 to 2% range. Here, as you know, we've been watching the S&P relative to everything. This is a measure of wealth. We think oil is a leading indicator to another one, but you can see wealth fell apart in the 70s into the early 80s, according to this measure. And it threatened to do that again recently with the Straits of Hormuz and the Iran war, but it's rebounding nicely. And on the next page, an even stronger measure of true wealth, S&P relative to gold, again, fell apart during the 70s, was threatening to do so here again. It did break below a range, which made us a little uncomfortable, although crude oil was not, or S&P to crude oil was not validating it. Nonetheless, we're happy to see it's on its way up again, and we think it has far to go in this technology revolution. Here's Bitcoin to gold. Gold is going down. Bitcoin had been going down. It seems to be in a bottoming process. We believe that it has bottomed on this basis and will resume the very volatile but broad uptrend that you see on this chart.
Cathie Wood is breaking down something that affects every one of us, whether we realize it or not, the U.S. government's balance sheet. She starts with a deep dive into fiscal policy, zeroing in on the federal deficit as a share of GDP. Treasury Secretary Scott Bessent, she notes, is aiming to shrink that deficit by the end of fiscal 2028. Here's why these matters to you. Bringing the deficit down to 3% of GDP is a goal largely within Congress's control, and it only requires about half the savings needed to balance the budget outright. That's achievable, with nominal economic growth projected between 3.5% and 3.8% per year. Hitting that 3% target would put the debt-to-GDP ratio on a downward path, with a little breathing room built in. Now, let's talk about the number that's been making headlines. Wood doesn't shy away from it. Government debt has climbed past 100% of GDP, a milestone that has plenty of investors worried. But she pushes back on the panic, arguing this figure only tells part of the story when viewed alone. The data shows just how big this challenge really is. The national debt reached 100.2% of GDP at the end of March, according to the Bureau of Economic Analysis. Debt held by the public hit $31.27 trillion as of March 31st, while nominal GDP came in at an estimated $31.22 trillion over the prior 12-month period. Let's get back to the video.
We're starting with fiscal policy. And you can see, as usual, deficit relative to GDP. The green line there is where Treasury Secretary Bessent is aiming to take the deficit by the end of 28, or at least fiscal 28, so September of 28. We think that he and this administration will achieve a much lower deficit because growth is going to be much stronger, we think, than is in most forecasts, including the government's own forecasts. So on the next slide, I want to continue here with fiscal policy. Here is a chart. The green line is debt, government debt relative to GDP. So it's over 100%. And that has many people very concerned. Now, you can look at the purple line, and that's debt relative to equities in the United States. And you can see that is on a downslope. We like to think of equities as representing wealth out there, so debt relative to wealth going down. Nonetheless, as I was traveling around, this debt to GDP ratio has been getting a lot of press, mostly because people think that interest rates and inflation are going to be stuck at these levels for a very long period of time because the debt seems intractable. And we can only bail ourselves out of this problem by inflating it away. We disagree entirely. We're not as alarmed by this number. We do think that as this government focuses on getting that deficit down, that debt relative to GDP will start to come down again, especially if we are right that growth is going to surprise significantly on the high side of expectations. So here I wanted to take a look at both fiscal and monetary policy in a single glance to show the contrast between today, now that we have pretty much, we are on the other side of the COVID boom bust, and the 60s and 70s. And you can see how different it was back then. The purple line was federal outlays, and you can see what so-called guns and butter did back then. Guns, we were in the Vietnam War, so defense spending was booming, and guns and butter, the social programs that were put in place back then, all ballooned government spending. And you can see from the green line, while it didn't accommodate it altogether, over time, money growth accelerated and really by the late 70s was accommodating all of this spending.
AI is rapidly changing the way the economy grows, businesses operate, and new opportunities are created. As innovation accelerates alongside stronger economic growth, many of today's biggest concerns could begin to ease. If inflation and deficits continue to move lower, the investment landscape may look very different over the next few years. For investors, staying focused on long-term trends instead of short-term headlines could prove to be the biggest advantage. Do you think AI will solve today's economic challenges faster than most people expect? Share your thoughts in the comments. And if you enjoyed this discussion, don't forget to like, subscribe, and turn on notifications for more insights on AI, the economy, and the future of investing.